Good evening, everyone. Good evening. How are you all? Good evening, everyone. All are good. We were into the chapter of cost of capital, correct? Right, guys? Yes, cost of capital. Okay. Yeah. So in Surat, very heavily raining. Really, but not in Mumbai as such. We do have rains, but today it is maybe a holiday for rain for Mumbai. It has gone on a trip to your city, possibly. Okay. So Pune also raining. Okay. Enjoy the rains along with the FM lectures. What can I say? Anyways, guys, so we have already started with the chapter of cost of capital, and we have started with the cost of debt, right? And we first understood why do we really need to calculate the cost of capital. Then I'm receiving your messages. Okay, I'm receiving your messages. Okay. Good evening, Nitish. Then we went ahead and understood that we're going to calculate the cost of debt, which is by approximate method. YTM or IRR method is also done. We are going to also see what's the bond amortization. Then we are supposed to calculate the cost of preference share. Again, cost of preference share is already covered by us. So cost of debt, we have stated that cost of debt is going to be computed as interest into 1 minus T plus redemption value minus net proceeds, the whole divided by N, and then the whole divided by net proceeds plus RV by 2. Okay. Similar formula we also had for the cost of preference share. Okay. So cost of preference share, interest instead of interest into 1 minus P, we just take the preference dividend. Then we have also discussed about how do we compute this cost by taking another example. And then finally, we had where has that thing gone? It's completely disappeared, the IRR method. Okay, so we're going to use this IRR YTM method on this typical question that we had. So we'll apply the IRR or the YTM method on this question today. We have already discussed about that in one of the previous questions. Now let's apply the same method to this question over here. The cost of debt, we're going to calculate using the YTM or IRR method. Now for that purpose, we'll have to first write down the cash flows that we are going to get, that's going to happen from this debenture. So we say year and then the cash flows. So we have in year 0, what is the amount that we are going to receive? In year 0, we are going to receive, can I say 980? Correct? No? 931, correct. Because that's the net proceeds, right? So net proceeds is 931 after payment for the initial expenses, right? Then from year 1, 2, 3, 4, 5, for each of these 5 years, we are going to pay. I mean, the company is going to pay cash flows as, what is the outflow from the company? In each of the 5 years, what is the outflow for the company? What is the outflow for the company in each of these years? It's not 100, guys. It is 70. is 70, not 100. It's not 100 because you have that 30% tax saving. You remember that? We had 30% tax saving, right? So 100 minus 30, tax saving is considered over here. So 70 is the outflow. And also in the fifth year, how much is the outflow going to be? The fifth year, what is the outflow? Fifth year, we have already taken into account 70. Now, redemption value in the fifth year is 1050. It is minus 1050. Can I just combine these two and say that in total, we're going to pay 1120 in the fifth year? Can we combine it and say that it is 1120 in the fifth year, guys? Correct? Yes, guys. Okay. Now, when we were looking at the IRR method, we were trying to make, we formed that equation. Equation was basically 931 will be equal to 70 upon 1 plus the cost of debt, right? We were getting the equation. We're trying to form an equation, right? So 70 plus cost of debt, 70 upon 1 plus cost of debt, 70 upon 1 plus cost of debt, and then finally, last one was 1120 divided by cost of debt. Correct? Am I right, guys? Okay. Then, of course, in between, there is going to be this plus sign. Right? So, you get the equation. Yeah. This was the equation. Of course, we need to give the denominator. We need to provide a power with the denominator. This is to the power of 2. Then second year is going to be to the power of 3. Correct? Then it is in this, we have this to the power of 4. And of course, we know in the last year, it is going to be 1120 divided by 1 plus KD to the power of 5. I said this was the equation that was getting formed, right? Correct, guys? All right. Yes, so this was the equation that we were having. Now we need to solve this with a particular value. So let us say what is the rate of, what's the rate of coupon, which is 10% over here. So we'll assume cost of debt to be 10% and try to get what is the value of RHS, not RHS, sorry, LHS. LHS value at cost of debt equal to, let's say, 10%. At KD equal to 10%. What is the value of LHS, by the way, guys? Can you get this equation? Can you solve this? Get me the value of LHS. This entire part, 70 upon 1 plus KD. Take KD as 10%. So this entire expression will become like 70 divided by 1.1 plus 70 divided by 1.1 square plus 70 divided by 1.1 cube plus 70 divided by 1.1 raised to 3 and then raised to 4. Then plus 1120 divided by 1.1 to the power of 5. Tell me what is this whole value? What is the value of this and all the expression together? Give me the value of all this expression together. Is it coming out to be 960 somewhat? Is it 917.528, everyone? LHS value at 10%. Is it 917.38? Yes, Adik. I'm able to see your messages. Let me again rename this to avoid any sort of confusion. Okay, great. Are we getting this 917.32 LHS value, everyone? Calculate power 3. Just need to multiply and then press equal to twice. Realme C15 Qualcomm. Okay, so it's like 1.1 into equal to will give you power of 2. Again equal to you will get power of 3. Again equal to will give you power of 4. Okay, 917.32. Now, of course, what is the value that we need? What's the value that we need for LHS? We got this as 917, but the value that we need is 931. What should I do? Should I increase the rate of discounting or decrease it? Should I increase the rate of discounting or decrease? Because I need to increase the value. I need to decrease the cost of debt. So give me the LHS value at cost of debt equal to, let's say, 5%. So at 5%, try to get the value of LHS, guys. Give me the LHS value when we are looking at it from 5% point of view. Check what is the value of the yeah, guys. Check what's the value at 5%. See if it is coming out to be 1125. Check if it is 1125.77. Let's just value at cost of debt of 5%. Just verify if you're getting this value as 1125. You're getting this? Okay, perfect. Guys. Now going for the IRR thing or the YTM method. As we have seen, we simply draw a diagram to understand it, right? How can we calculate cubic root? I'll do that for you in the last part of our session. Find the cube root, okay, guys? Now, when we were discounting it at 10%, the value was 917.32. Now, when we are discounting it at 5%, the value is 1125.77. What is the required value of the debenture? What's the required value of the debenture? 931. So somewhere over here, it is 931. Right? Somewhere over here, we have this as 931. So we'll see for what is the change in percentage. and what is the change in the value. Percentage change is, what is the percentage change? By what percent has the rate of interest changed? Can I say it has reduced by 5%? Correct? So it has reduced by 5%. What is the change in the value of the debenture that we are observing? For a 5% reduction in the rate, what is the change in the value of the debenture that we are looking at? 1125, it has increased, right? So it has increased by plus from 917.32 to it has become 1125.77. What is the difference? Look at the difference. Because of rounding up thing, you can definitely have different values, but that's okay. So it is 208.44. So there is a change of 208.44. What is the change that we really needed in the value? What change were we looking for in the value? From 917.32 to 931. What was the change that we were looking for? What was the change that we were looking for? Tell me, guys. From 917.32 to 931. We were looking for a change in value by 13.68. So we want to increase the bond value by 13.68. Correct? We want to increase the bond value by 13.68. So I think we would be able to calculate now what percentage change are we looking at. What percentage are we looking at? 13.68 into, of course, minus 5% divided by 208.44. What is the percentage change, guys? Tell me. What percentage change are we looking at? 13.68 into 5 divided by 208.44. 13.68 into 5 divided by 208.44. That is 0.32. Correct? 0.32 or 0.33, can I say? So we were looking for a reduction of 0.33%. Right? 0.33%. So what will be the cost of debt over here? What will be the cost of debt? It will be 10% minus 0.33% is nothing but 9.67%. Okay, so we were going down from 10 to 5, right? And we wanted to increase it from 917 to 931. So your cost of debt using the IRR or the YTM method is 9.67%. This is what we have already covered in the previous class. So I just thought, let me quickly revise this YTM method for you before we go for the next topic or next concept, which is discussing about the again cost of capital, but now we are looking for cost of equity shares. Shall we proceed for cost of equity discussion, guys? Yeah. Shall we go for cost of equity? Yep. Chalo. Yes, approx. It's going to be closer to the approximation method. Okay. But this is the more accurate way of calculating the cost of debt. Will be going to be closer to the approximate method. Okay. Now let's go for the next concept of discussion, which is cost of equity. Okay. Now, cost of equity is who are the equity shareholders? Who are the equity shareholders for a company? Yep. Tell me, guys, who are the equity shareholders? They are the owners. They are the owners. They are the people who own the business entity, right? They are the people who are basically interested in well-being of the company or future growth of the company. They are interested in getting wealth generated from the company. They are not someone who want to, have a short-term gain and then just take away from the and then just move out of the company. So equity shareholders, guys, as we say, they are the owners of the company. They are the person who are, very much close to the company. Now, understanding what is the return that I should provide them is a very difficult task, guys. Like, for example, uh, suppose you are doing this CA course by taking a bank loan. Suppose you're paying the fees or you're incurring all your expenditure for the study course or maybe any education. You're taking a bank loan. Will the bank will the bank loan or the banker specify the rate of interest? Will the bank loan or the banker specify the rate of interest that will be charged to you from on your education loan? Yes or no? Yes. So that's a peculiarity of debt and preference shares, that they generally tell you what is the rate of interest they want in the form of percentage. But if you take, let's say, this project, let's say you're doing this CA course with the help of funding from your parents. Who are the parents? They are your equity shareholders. They are interested in your well-being. Now tell me, are the equity shareholders, that is your parents, are they going to tell you that once you qualify or once your education is complete, you should return us back the money that we invested in you by giving so much amount of interest? Or they may not call it as interest, but they will say, see, we have spent, let's say, 2 lakhs on your education. So this was a project for us, and we want a return of, let's say, 15% on the money that you have spent on it. Do they specify that thing to you? No. Why? Because they are owners. Acha. They are owners. They don't specify the rate, but does that mean they have no expectation from you? Does that mean they have no expectation from you? Can I say their expectation is far greater than what a banker has? Can I say their expectation, the owners or your parents or the equity shareholders for that case, are having a expectation greater than the banker? Banker generally expects what rate? It will give you, like, you will simply ask you to give a rate as 12% or 13% or 14%. And once you pay the interest, pay back the principal, the relationship between you and banker is complete. But when you look at your parents or when you look at the equity shareholders, understanding their expectation is a very difficult task because their expectation is far more than what you can really imagine, right? How many of you would have experienced, like uh, if you have got, let's say, 80% in one of your exams, your parents should be like, next time aim for 85. If you get 85, then they will say aim for 90. If you get 90 in some of the exams, then they would say you should aim for 95. And if you're getting 95, they will say you should aim for 100. Am I right? Have you experienced this anytime? Can I say their expectation is not something which is, constant? Their expectation is not constant. Like in case of a bank loan, you took a bank loan and you paid the interest on time. Next time when you take a bank loan, will the banker, say that, no, oh, you are paying the interest on time, so we would like to get a higher rate of return from you, or maybe a lower rate of return from you? Is that going to be the case? No. But when it comes to equity shareholders or owners, their expectation are generally going to be higher as compared to your debenture holders. Another reason why you would like to have your equity shareholders expecting more return from you is a simple reason, because they are undertaking a risk. They are undertaking a risk by investing in the company. I hope you might have heard something called as investors have residual interest in the company. Have you heard of this term? Equity shareholders have residual interest in the company. What does that residual interest mean? So if something goes wrong with the company and company goes for liquidation or winding up, money will be paid to the equity shareholders. Money will be paid to the equity shareholders only after payment of all other liabilities. So don't you think this is a risk for the equity shareholders? And the basic fundamental of equity of this finance is, higher the risk, higher will be the return that you need. Am I right, guys? Correct, guys? Higher the risk, higher is the return. Since equity shareholders are obviously taking a higher risk, they will require a higher rate of return on their investment, and company will have to generate that much return. Okay. So can I say that cost of equity is going to be higher than cost of debt and cost of preference shares as they undertake more risk than the debt or preference shareholders. Correct, guys? Okay. But there are, it's very difficult to know what is the expectation of the equity shareholders. And to understand that same thing, you will find lot of theories have been developed. Lot of theories. You will find hundreds of theories have been developed to understand what are the expectation of equity shareholders, right? Because every financial economist is thinking from different perspective, and they think that equity shareholders may be needing some different rate of return, right? They may be requiring some, different rate of return. They may be requiring return in other form, right? You may have certain set of your equity shareholders who would be expecting cash income from the company, right? Who would be interested in the dividend of the company. You may have some equity shareholders who would say, the company should earn more and more and reinvest that money to generate wealth rather than paying out dividend. So there are different perspectives always possible with the equity shareholders' expectation. And therefore, what we find is there are multiple theories to understand what is the cost of equity or what are the expectation of the equity shareholders. Okay, so there are different approaches, out of which we are going to cover certain approaches. One is the dividend price approach. Okay. Second is earnings price approach. Third is uh, the dividend growth approach. Right? Then we have something called as realized yield approach. Right? And the last, which is called as CAPM or capital asset pricing model. Okay. So we have dividend price approach, earnings price approach, growth approach, realized yield approach, and capital asset pricing model. So these are the 5 theories that we are going to look at to compute the cost of equity, out of which let's get started with the first one. First one is a very simple approach, and even second is also a very simple approach. The dividend price approach. The dividend price approach is this is an approach which is rightly used for those shareholders who are really interested in the uh, dividend payment by the company. Okay, so it is like, what is our shareholders expectation? If you want to know what is our shareholders expectation, that's going to be simply dividend multiplied by the current price. So this is dividend multiplied by the price. Simple. That's the pretty simple formula that we have for the dividend approach. Right now, by simply dividing your dividend with the price, you can understand what is the expectation of the shareholders. Like, for example, suppose dividend per share and market price per share. I give you some sort of data. The company paid a dividend of 3 rupees. At that time, market price was 30. Then when the company paid a dividend of 4 rupees, market price became 40. When the company paid a dividend of 2 rupees, market price became 20. When the company paid a dividend of 5 rupees, market price became 50. Can you tell me what is the return the equity shareholders are expecting in this scenario? Because based on your dividend, market price is getting adjusted. Because shareholders are not going to express anything by way of words that we want so much return. They are going to express everything by way of their actions. They're going to express everything by way of their actions. Now, what do you mean by actions? Actions will be basically the share price. If the investors are satisfied with the dividend that you're paying, or if they are doing good with if they're okay with the dividend that you're paid, they will maintain the market price. Whereas if you're giving more dividend, then the market price is rising. When you pay less dividend, market price is falling. Right? So we observe that the relationship between the dividend and market price is what? 10%. The investors are generally assigning a 10% value for the dividend per share, based on which the market price per share is computed. Okay, is this formula clear, guys? So K is dividend upon price. Is this clear, everyone? Dividend price approach? Yes? Okay, perfect. Now, the next approach is earnings price approach. Earnings price approach. Any guesses what will be the formula as per this method, as per this approach? Earnings price approach. Perfect. It is EPS upon MPS. Right? So this is earnings per share upon market price per share. This is calculated under an assumption that shareholders are not interested in the dividend of the company, but they are really interested in what the EPS is being generated, what amount of EPS is being generated by the company. Is it clear, everyone? Earnings price approach, right? Income upon investment. So income is basically your EPS, and the investment is the market price that the shareholders are paying. Correct? So this is our earnings price approach. Pretty simple. Now let's go for the third approach. So we have done with dividend price approach, which is dividend upon price, earnings price approach, which is EPS upon MPS. Now the third one is dividend growth approach. Now here the things are going to be turned to be really interesting. See, we know as a rule of finance that current price of the share will be equal to present value of all future dividends. Right? So price of today, whatever price you pay, can I say you pay to acquire any asset or you invest money only if you see something benefit coming to you in future? Am I right? Yes or no, guys? You always spend time and money only on those areas where you see that something benefit is going to come in the future. You are now spending your Saturday evening over here with me, right? Learning this chapter of cost of capital. Aren't you expecting anything benefit coming to you in future? Yes or no, guys? This Saturday evening, we both are sitting over here, right? And spending our time, which we would have spent, maybe with our loved ones, right? So we are expecting obviously some future benefits, right? Some future benefits. So same way, price of the share will be also dependent on what future benefits your future dividend that you're going to get, right? What future dividend you are going to get, that is what we are expecting. Okay. So let us say the dividend that you're going to get in year one is D1. How do I get the present value of this D1? How do I get the present value of the dividend? Present value of first year dividend. Can I say it is simply D1 upon 1 plus K? K is basically the rate of return which the equity shareholders require, cost of equity, right? Plus D2 upon 1 plus K square, right, guys? Plus D3 into 1 plus K cube. And this will go on till perpetuity because we always have the assumption about what assumption do we have about the future earnings of the company, that company is a going concern, right? We understand going concern. It means company is going to exist forever as of now. I mean, foreseeable future is that company is going to continue its operation for a longer time. Now, can you tell me, do you expect that first year dividend, second year dividend, third year dividend, fourth year dividend to be remaining constant? Being a equity shareholder, think about your parents. Think about your parents. Were they expecting the same percentage from you every time you scored something, or they expected a growth in your performance? There has to be growth in the performance, right? So can I say that dividend in year one cannot be same as dividend in year two? And even dividend in year three won't be same as dividend in year two. Correct? Right, guys? What is the meaning of PV of future benefits? PV is present value. Value of anything. Pawan, value of anything is simply present value of all future expectation that you have. The future benefits, the future dividend that you're going to get, the present value of the same is going to be the value today. Okay. So the dividend has to be generally growing, sir. So if it is first year, then we say D1 upon 1 plus KE, right? And P0 is the current price of the share. Yes, the current price of the share is the present value of future dividends that you're going to get. Plus, instead of D2, can I write it as D1 into 1 plus growth rate? Can I say second year dividend is going to be additional growth over and above the first year dividend? Correct, guys? What about D3? D3, can I say it will be D1 into 1 plus G square, because growth will be for 2 years. Dividend is going to grow for 2 years. Then divided by 1 plus KE. So D1 upon 1 plus KE plus D1 into 1 plus G upon 1 plus KE square plus D1 into 1 plus G the whole square upon 1 plus KE cube. And this goes on till perpetuity. Okay. Yes, Srini? Want to ask something over here?
Yeah, sir, if the company is a growing company and if the company is not paying any dividend, even though the company is not paying dividend, the earnings is growing, right? So why can't we use earnings in the place of dividend?
Why can't we use?
Earnings, profit after tax.
Profit after tax. So
yeah,
this model is looking at only dividend right now. As I said, there are multiple approaches to that. This model is looking at dividend expected from it, because if the company is going to retain earnings,
No, but
it is obviously
wait. Yeah.
If the company is earning, what is company going to do with those earnings? It has to distribute one day or the other to the shareholders, right?
Not necessary, sir, because if it is growth company means they can retain the 100%, right?
How long? How long?
Apple was till that time we can calculate based on earnings.
Based on
earnings.
Earnings. What will company do with those earnings?
They will be retaining it and they will invest in new projects with that earnings. Internal accruals, they will be investing it in new projects and they will
they invested in new projects. What will happen from new projects?
They will be earning that return from that new project.
Okay, the return that you receive from new projects, what will you do with that?
They'll be investing it in new project, in the same project or in additional or in again a new project.
They invest in the new project. What will they do with the income that we receive from the first and the second new project? So after a period of time, the company cannot be a growth company forever. Over a period of time.
So that's what my doubt was like till that time whether we can use earnings in the place of dividend, because anyway it's a growth approach.
Hold on.
Yeah.
So this model assumes the dividend coming from a company. Okay. So there are, as I said, hundreds of different models available to calculate the cost of equity. So there are different models which take earnings into account, right? So like your earnings model, then these are, again, there are advanced models which don't consider the earnings, which there are models which consider risk that we have in a particular company. So we're going to look at that aspect also. Right now, this is one of the model where we are assuming that dividend is going to grow at a particular rate. Okay. There can be fluctuation in dividend payment. Yes, there can be fluctuations, but again, we are looking at these models with certain assumptions that it's going to grow at a particular rate every year. Anirudh?
Hello, sir.
Yeah, Anirudh.
So, sir, you're saying that dividend will grow,
Ah,
but in this equation,
hmm.
the G signifies growth.
G is
So,
signifying growth, yes.
are you saying that that the growth will be same percentage, or will it
Yeah, this model assumes that if you take the growth percentage to be same, then how to calculate the cost of equity. So see, I'm stating already that there are multiple approaches available to calculate the cost of equity. Okay, it is very premature at this stage to bring ifs and buts, because there are thousand such ifs and buts available, because this is not something where you're trying to calculate something based on facts and figures, just like debentures. In debentures and preferentials, there's no second thought, it's a straightforward thing. But here you're trying to understand the expectation of equity shareholders. Okay, so understanding the expectation of equity shareholders is a different process altogether. One way is to assume that it is going to grow at a constant rate. You can analyze the dividends of a particular company. It may be growing at a particular rate, it may be growing at a different rate, but on an average, there has to be some common rate. Okay, so this is a mathematical model that we are looking at. Okay, now, so this dividend that we have growing, now growing at a one single rate. If we look at this dividend growth that is happening, this particular series, does it seem like some series to you, some mathematical series? Does it seem like some mathematical series? I don't know if you have learned this series or not. There is something called as geometric progression. Now, geometric progression till infinity, if we have summation of a geometric progression till infinity, what is the formula for that? A upon 1 minus R. Right? A upon 1 minus R, where A is the first term. So first term is D1 upon 1 plus K upon. What is the multiple over here? What is the multiple? What is the multiple? What is getting multiplied every time? Expression after expression, what is getting multiplied every time? It's 1 plus. Can I say the multiple is nothing but this portion, see? 1 plus G. And also it is 1 plus K getting multiplied again and again. So it is 1 minus, multiple is 1 plus G upon 1 plus K. Correct? If we just simplify this, this becomes d1 upon 1 plus k, the whole divided by 1 plus k minus 1 minus g upon 1 plus k. So your 1 plus k gets cancelled. And what we have now is d1 upon k minus g. So this is the formula that we have. Price under an assumption that dividend is going to grow at a constant rate. This is d1 upon k minus g. D1 upon k minus g. Now, can we rearrange this to get the value of cost of equity? We can rearrange this. So, cost of equity is equal to cost of equity is equal to, or we can say cost of equity minus g is equal to P1 upon P0. So, finally, cost of equity is P1 upon P0 plus g. This is the formula for getting the cost of equity. This is the formula for getting the cost of equity, which is P1 upon P0 plus G. Now, what is the assumption underlying over here? What was the assumption that we had in this model? That your dividend is going to, is the dividend going to be constant or growing? The dividend is going to grow. Is it growing at different rates or is it growing at a constant rate? It is growing at a constant rate. Okay, then this formula is going to work. If it is different rate, then we will see how to compute that. Just hold on. The next point is the same thing that we are going to discuss. If the dividend is growing at not a constant rate but at some different rate, then how do we compute that? So right now what we have done is dividend price approach is dividend upon price. Earnings price approach is EPS upon NPS. Okay. Then we have the dividend growth model, which is dividend constant growth model, which is D1 upon P0 plus G. Are all the three models clear till now, everyone? All the three models clear, everyone? Yes. Yeah. Yes.
Sir,
Are
can you
there
please give the each letter explanation? Can you give side by sir, please? Because we will note down.
what
PO,
explanation?
what is meant by PO, sir? PO.
PO is price. PO is the price.
We want, sir, that for each letter, if you write, we will note down, sir. That's what.
P0
Because
is the
future
price.
we may not remember. PO is price.
Price today.
Today's price, sir.
Yes.
Remaining, sir.
P1 is dividend.
Okay.
K is cost of
equity.
Yes.
Then GP came, sir. What is GP?
Geometric progression.
Okay, A, sir. A by 1 minus R you have given.
That's the A is the first expression. This is GP done in the school days.
Okay, this is not required for us, not required for us. Okay.
No, not. You need to remember this formula. That's it. A is equal to D1 upon P0 plus G. So D1 is the dividend that you pay, dividend that you're going to get in the first year. P0, it is the current market price, plus G is the growth rate.
Growth rate for current year or future?
Growth rate is constant here.
Huh?
Growth rate is a constant number here.
Current year, because CAGR changes every year, sir. CAGR changes.
No, it is not CAGR. It's a constant growth rate that you get every year, not a CAGR year.
It is not CAGR, na?
No, not CAGR.
Okay, okay, sir.
Yes, Bhavna.
Sir, I have a doubt regarding the formula. Why we are dividing dividend by 1 plus KE?
Why? Dividend? Sorry.
Divided by 1 plus cost of equity.
Divided by 1 plus KE.
Yes, sir.
Why are we taking D1 divided by 1 plus KE?
Yes, sir.
Tell me the formula for present value and future value. We did it yesterday. You know, it is A is equal to P into 1 plus I. Correct?
Yes, sir.
So how to get the present value then? How do you get the present value? You know, A is equal to P into 1 plus I raised to N. If you want the present value, it will be A divided by 1 plus I raised to N. And when it is equity shares, I will be cost of equity.
Yes, sir.
A is the amount that you're receiving in future.
So cost of equity like interest.
Cost of equity is the rate of return expected by equity shareholders.
Yes. Okay, sir.
Okay. Okay. So now we have done three models as of now. One is the constant, or I can say dividend price model, earnings price model, and dividend growth model. Now the fourth model is realized yield approach. Okay, it's going to be the realized yield approach. Okay, realized yield approach. Now, realized yield approach is basically calculating the rate of return that you as a shareholder or equity shareholder is earning by investing in a particular share. So if you're going to purchase a share and then you're going to sell it off after a certain period of time, then what is the rate of return that you're earning is what is going to be calculated over here, realized yield approach. So let's say in year 0, you purchased a share. In year 0, you purchased a share for a price of, let's say, 1,000. So will that 1,000 be an inflow or outflow? It will be an outflow, right? This is outflow of 100. Then suppose in year 1, 2, you received dividend from that one. You received dividend of, let's say, 25 rupees in the first year. You received dividend from the company, let's say, of 50 rupees in the second year. And in the third year, you received a dividend of 60 rupees. And finally, in the third year, you're selling the shares of the company for a price of, let's say, 1,400. So will that 1,400 be an inflow or outflow? When you're going to sell the shares and you're going to get the 1,400 amount, that's obviously inflow, right? Now, if I ask you, what is the rate of return that you have earned on your investment in this case? How are we going to calculate the rate of return that we are earning on this share? Rate of return that we are earning? How do we calculate the rate of return? Can I say same approach that we did for IRR approach or YTM for cost of debt, right? Similar approach. So we can simply write down this cash flows in the form of an equation and try to calculate the present value factor, right? So present value factor, let's say at the rate of 10%. Now, what is this meaning of this present value factor? Present value factor. We have heard of this present value factor in foundation, correct? Present value factor is simply current value of ₹1 in future. Current value of ₹1 in future, which is nothing but what is CF? Cash flows. So here and cash flows are available. So we purchased a share and we received the dividend, and finally in the third year we are going to pay off. We're going to sell the shares. So what is the rate of return that we are getting? That's what we are computing. So if I ask you what's the present value factor, like it's going to tell us what is the value of 1 rupee today, the rupee that you're going to receive in future. How do we calculate the present value factor? You might have learned this in foundation. Foundation quantitative aptitude. Time value of money would be a chapter, right? So how to get the present value factor here? 1 divided by, this is 1 divided by 1.1. What will be the present value factor for the second year? You can actually get the present value factors simply by using the calculator. Let me just show it to you. Okay, 1 divided by 1.1. That'll give you 0.909. If you want the present value factor for second year, you press again equal to, right? So that is nothing but, over here we say it is 1 divided by 1.1 to the power of number of years. Then we take the same values. right? You say it is 0.826. Again, you press equal to, you get 0.751. Again, you press equal to, you get 0.683. But 683 is not needed because we are looking at only 3 years. So how to get the present value of the cash flows? Present value of the cash flow, cash inflows that you're receiving, present value of cash inflows. It will be just cash flow multiplied by the present value factor. It's nothing but cash flow multiplied by the present value factor. So this 22.75 is nothing but 25 divided by 1.1. And what is this? 41.32. 41.32 is 25, but not 25. This 50 divided by 1.1 square. So instead of calculating individually, we simply take the present value numbers. Now, the total present value is working out to be 1160.97. So if we say that we are buying the share at 1,000 rupees and we are going to sell it at 1,400 after receiving this dividend, and if I'm saying that I'm going to discount it at 10%, I'm getting this as 1160 present value. So, but what is the amount that I'm paying to acquire this bond? To acquire this equity share? What is the price that I'm paying to acquire this share? What is the price that I'm paying to acquire this share? 1,000, right? But we are getting this as 1160. So I want the value to be 1,000, guys. I want the value to be 1,000. Right? I want the value to be 1,000. So it means the security or this equity share, is it giving you 10% return, more than 10% or less than 10%? What's the rate of return that is being given by this security or equity share? If it is 10%, the value should be 1160, but we are getting it at 1,000. So it means we are not getting 10%, but rather this security is giving me more than 10%. So just do one thing, get the present value factor at maybe 15% and then calculate the PV. Year is 3 only. Apurv, the year is 3 because we are selling this in the 3rd year. Okay. Yeah, give me the present value. Give me the value of the present value of all these cash flows. If your PV factor is 10, PV factor is 15%. Calculate the PV, guys. Yes, Hardik, you were saying something.
Sir, can you please once again explain model 1?
Model 1.
Yes, sir. सर मॉडल 1 समझ में नहीं आ रहा सर.
कौन सा मॉडल?
मॉडल फर्स्ट जो फर्स्ट करा था सर, एक एग्जांपल.
डिविडेंड प्राइस.
यस सर, इन दोनों का एक एग्जांपल.
ये तो सिंपल है बेटा, डिविडेंड अपॉन प्राइस, और कुछ नहीं है. इक्विटी
तो
शेयरहोल्डर्स को कितना रिटर्न
dividend
चाहिए,
price
उसके लिए यू जस्ट नीड टू डिवाइड द डिविडेंड विद प्राइस.
3 divided by 30.
30, 10%, 4 divided by 40, 10%. So it is like for every dividend that you pay, market price कितना मूव हो रहा है.
सर इसमें डिविडेंड प्राइस अप्रोच में एक्स डिविडेंड लिखा है, तो डिविडेंड को एक्सक्लूड कर देंगे ना मार्केट प्राइस से.
डिविडेंड को
एक्सक्लूड कर देंगे ना मार्केट प्राइस से. एक्स डिविडेंड लिखा है बुक में.
एक्स, हाँ तो एक्स डिविडेंड ही देखेंगे ना हम.
तो एक्सक्लूड करके देंगे.
हाँ, बिफोर ये प्राइसेस अपने एक्स डिविडेंड वाले ही है.
अच्छा, एक्स डिविडेंड वाले. ठीक है सर, बस यही चीज कंफर्म करना था. और सर एक बार सर क्यूब रूट भी निकालना सिखा दोगे सर?
क्या क्या?
क्यूब रूट निकालना सिखा दोगे सर?
वो लास्ट में दिखाता हूँ बेटा, कैलकुलेटर पे लगेगा वो, इस पे नहीं होगा.
ठीक है सर, थैंक यू सर.
Yeah guys, PV factor at 15% कितना आता? 1 divided by 1.15 the power of number of years. वैसे हमने we just got the PV factors for each of these years. Then we get the PV as present value factor into cash flows. Then we do the summation. What do we observe? coming out to be 1011. Have we reached the 1000 thing? Have we reached the 1000? We want this to be 1000, right? The value, we are targeting the value to be 1000. We are targeting the value to be 1000. No. So 15%. So at 15%, we find that value, the present value is not equaling the value right now. So what should we do? Increase it slightly. So let's take present value factor at the rate of 20% and give me the PV, guys. Give me the final PV answer after calculating 20% pay present value. Give me the present value, guys. Okay, give me the PV factors. 1 divided by 1.2. That will be to the power of 2. Power of 2, my bad. Power of number of years. This will be your PV factors. You can get these PV factors simply. You're aware, right? You can get it as 1 divided by 1.2 equal to just need to do to get the PV factors. Then you multiply the cash flow with PV factor. This comes out to be totaling to the total value is 900.46 or 899. There may be some rounding up error. That's okay. Some rounding error is possible. That is fine. No problem. Now, again, here it is a situation at 15%, we had the value as 1020. Let's round it up. And at 20%, we have the value as 900. What is the value that we need? What is the value that we need? We need the value to be 1000. And we want to know what is that rate at which the value will be 1000. Can you calculate this rate now, guys? Can you calculate this rate using the same IRR or YTM method approach like we did in the previous one? Correct? Yeah, tell me. Calculate the value of X and give me what's the rate of return. Calculate the value of X and give me the value of the rate of return. That rate of return will be our realized yield. So the change that we observe here is there is a fall by 120, and in the return there was an increase of 5%. Right? So percentage change was plus 5% and value change is minus 120. What do we really need to make the value? We want to reduce the value by just 20. So simply doing the cross multiplication will give us this percentage. So 20 into 5 divided by 120. How much is it? 20 into 5 divided by 120 gives us positive 0.833. Can you tell me what will be the IRR, guys? What will be the IRR or what will be the realized yield? Realized yield, the rate of return which the equity shareholder is getting, can I say it is 15 plus 0.833, which translates to 15.833%. This is the approach of calculating cost of equity, which is the realized yield approach. Okay, Everyone? So 4 approaches done. Constant dividend, constant earnings, earnings growth model, and realized yield. The last and the 5th approach is pending, guys. Let's do it right now. Last and the 5th approach, which is called as capital asset pricing model. Now, this is not based on expectation regarding the dividend or regarding the share price, but rather this model is like KE depends on risk involved in the company. KE, this model says that KE, cost of equity, is going to tell us, or it's going to depending on the what is the risk involved in the company. And you're asking what will be 15.83 signify? 15.83 is the cost of equity of the company using realized yield approach. Right, so it means the equity shareholders have actually gone 18, have actually got 15.83% return from the shares. That's the rate of return which the shareholder has got. Is it clear, Anirudh? Okay. So coming to capital asset pricing model, guys. The capital asset pricing model is simply looking for cost of equity will be dependent on the risk that we have in a stock. Okay. Now, if I ask you that there is a risk-free rate of return available in the market, is called as RF. What was the 4th method? Realized yield approach. Sadab, 4th approach was realized yield approach. So risk-free rate of return, RF. Guys, risk-free rate of return, RF is simply, let's say, 7%. So it's like without taking any risk, if you're going to invest in a particular government security, you're likely to get 7% return. Without any risk, if you're going to invest, you're going to get 7%. Now, if you're going to invest in any other security, do you expect the same 7% or more than 7%? Will you expect the same 7% or more than 7%? More than 7%, right? It's going to be more than 7%, right? So it depends on the risk, right? Whatever is the risk, of course, based on that risk, I will be expecting a greater return. Now, suppose I say return on market portfolio. Return on market portfolio means overall market, like your Sensex, your Nifty, the entire market that we have, the average return that we have. Average return on market portfolio is, let's say, 12%. So how much risk premium you are getting by investing in the market portfolio? What is the risk premium that you're getting by investing in the market portfolio? What is the risk premium that you are getting? What is the extra return that you are getting? This market return is going to be denoted by RP. What is the extra return that you are getting? 5%, right? It is like risk premium in market portfolio, which is going to be denoted as return of, going to be RM. Risk premium in market portfolio is basically RM minus RF. The risk premium in the market portfolio is RM minus RF. What's the return that we are getting? 5%, right? Now, let's say there is a company which is having double risk as compared to the market. What is portfolio? Portfolio means overall combination of all the investment that you make. You will have shares of Infosys, you'll have shares of HUL, you'll have shares of Reliance Industries. So all the market together is giving an average return of 12%. So the risk premium that you get is 5%. Then tell me if there is a security which is having double risk, than the market portfolio, what will be your risk premium expectation? What will be your risk premium expectation? Degree of risk as compared to market. Degree of risk as compared to market is, let's say, 2. It means we are saying degree of risk of share as compared to market. Okay, as compared to market, let's say degree of risk is 2. Now 2 over here means share is 2 times risky than market. So if it is 2 times risky, can you tell me what is the risk premium required from share? What is the risk premium that will require from the share? What's the risk premium that you require from the share? Can I say double? It's going to obviously 2 times of 5%. 2 times of 5% means it's going to be 10%, right? Okay. So you need a risk premium of 10%. Can you tell me what will be your overall required return from the share? Total return required from share. What is the total return that you will require from the share? Can I say it is obviously, sir, 7% plus this 10%. I will require a total return of 17%, because 10% is what you need. 10% is the risk premium. 10% is the extra return that you need. Obviously, you will require the risk-free return also. So I need risk-free return. I need risk premium. So total, how much return should I be looking from the share? 17%. Now this 17%, we know we got it as 7% plus 10%, out of which, what was this 7%, guys? What was this 7%? What was this 7%? Can I say risk-free rate of return, where the investor is facing no risk? Risk-free rate of return is basically earned on the government securities. Plus, can I say this 10% was, let me just write it as 7% plus 2 multiplied by 10%, 2 multiplied by, sorry, 5%. Now I can say it is 7% plus 2 multiplied by, this 5% is, can I say, return of the market minus 7%. Correct? So what was this 7%, guys? 7% was risk-free security. Correct? 7% was risk-free security. Plus, we did it as 2. What was this 2? 2 is the degree of this risk that we have in a share as compared to the market. 2 is the degree of risk that we have as compared to the market. So that is going to be beta. That term is going to be denoted as beta. Okay. So degree of risk that we have, this is also going to be called as beta. Beta multiplied by, what was 12%? What was 12%? What was 12%, guys? Can I say it was RM, market return, minus, what was again this 7%? Risk-free rate of return. This is the model of capital asset pricing model. So under CAPM, under CAPM, capital asset pricing model, we calculate cost of equity as risk-free security plus beta into market return minus risk-free return. That's our CAPM model for calculating the cost of equity. Okay, now don't worry about this. You will be given risk-free security number. You will be given beta number. You will be given the market rate of return also. So what you need to do is you just need to put all the numbers together and get the value. Simple. Okay. Let me address the queries if there are any. Yeah, Sai Kiran.
Sir, this risk-free returns only government securities. So bank deposits will not be taken, sir.
No, not bank deposits. Government securities.
Bank deposits will not come here.
Nah. Because government security, you say you get what 6%. Bank deposit you get 8%. So you get additional 2% because there is some risk that the bank may go bankrupt also.
Okay, sir. So what this beta signifies, sir?
Beta is the degree of risk that the share has as compared to the market.
It denotes 2, na, sir. It denotes 2, na, because from formula it comes 2, na.
No. This number will be given to you. How to calculate this beta is a part of your CO final.
The 2 is a beta. That calculation part is beta. Degree of risk of share.
Yeah, degree of risk of share as compared to the
beta.
market.
That is beta.
Means your share is double risky as compared to the market.
That is beta. Okay.
That is beta. Double. If it is triple, then beta will be 3.
Okay.
Hardik.
Sir, in realized method, if dividend per share and price per share is given, then how to calculate cash flow?
Sorry, what is given?
Sir, in realization method, if a dividend per share and the price of share is given, then how to calculate cash flow?
This realized yield will work only if you are buying the share and then selling it after some time. If you are just going to hold it, how you to calculate the realized yield?
But sir, in question 11, sir, I'm seeing a question. Their price is given and illustration 11 of study material. Their price is given and dividend price is given.
So that's a different approach. That's in the realized yield approach. There you have to take the geometric mean. That's not covered yet.
Okay, sir.
Okay, that will be covered in a separate chapter. That concept will be covered in a separate chapter. Then you will understand.
Okay, sir.
Yes, Srini.
Hello, sir. Is that market risk remains 1 in all cases, or it will change? Hello?
Sir, what is CAPM, sir? CAPM.
Hello?
Sir, CAPM.
CAPM.
Hello, sir.
Yeah, Srini.
Yeah. I ask questions like whether that market risk remains 1 in all cases, or it will change.
Market risk remains
1 because in this calculation we have calculated market
risk. It is always
as 1, right?
Beta is a relative term. So as compared to market, what is the risk of the security going to be? That's what is covered.
So market risk. So that's what. So market risk will be always
market beta
1,
is
or
always
it will
1.
Change?
Market beta is always 1.
Okay, market beta means it's stock exchange, or like it denotes some exchange, or market means it denotes exchange, right?
You're not audible properly.
Hello?
Sir, first it was given as KE, CAPM, sir. Subsequently it was given as KE, which is we can take, sir, which we can. CAPM or KE, sir? What is CAPM?
CAPM is the model, capital asset pricing model.
Okay, sir.
So let me finish. Okay.
क्या श्रेणी? विद्या?
Hello, sir.
Yeah.
Sir, I didn't understand the realized yield approach.
Realized yield approach is same as calculating the IRR approach. Were you there in the last class?
Yes, sir.
So there we calculated IRR, right?
Yes, sir.
IRR, YTM approach.
Yes, sir.
So we did the same thing over here. We simply took the present value of these cash flows and tried to equate it with 1000, because 1000 was the price that we were paying to acquire the share. So, but at 10% it was not 1000. At 15% also it was not 1000. At 20% it turns out to be 900. So we simply did an interpolation or the calculation between 1020 and 900.
Okay, sir.
Okay, so that's the same YTM method.
Okay, sir. Thank you.
CAPM समझ नहीं आया बेटा? समझ नहीं आया तो just look at this.
Sir,
P is simply risk-free return plus beta into RM minus RF. Beta is the level of risk that a company has. So risk-free will be given to you, beta will be given to you, RM and RF will be also given to you. Okay, so you are simply adjusting the risk premium that you get with the beta, that the risk that you have in the security. Yeah, Sheikh?
सर वो लास्ट एग्जांपल ही पूछना था मुझे,
Sorry?
YTM वाला।
हम्म
उसमें थोड़ा इशू हो रहा था सर। अब ये अपन इस रेट के पास जा रहे हैं, मतलब जो 1020 और 900 के पास, वो कैसा कंसिडर करने का सर?
कैसा कंसिडर करना मतलब जो इनिशियल जो कैश फ्लो है उस तरफ जाना है.
ओके,
इनिशियल जो इन्वेस्टमेंट है, वी हैव टू जस्ट गो अप्रोच टिल 1000, व्हाटएवर इज द प्राइस. अगर ये 900 होता है 900 की तरफ जाना है.
थैंक यू।
Okay, Kasak is asking here, market return and risk return is from the same security. Kasak, how can you have the same security giving you the market return also and risk-free return also? Risk-free return is the return that you get on a government security, right? And security at the market rate of return is the overall market rate of return that you observe in the market, like the return that Nifty is giving you, return that Sensex is giving you. How can the same security be risk-free as well as risky? If market price is given, based on market price, you cannot calculate the RM. RM can be calculated only using specialized tools. And therefore, we are not covering the method to calculate RM. Neither we are covering the method over here to calculate beta or RF. Those all things are going to be dealt in CA final. In this level, you will be given directly the numbers. Different security, Kasak. Obviously, risk-free will be a different security. So we are doing the comparative thing. On risk-free security, if I'm getting 7%, if government is giving 7% return on its security and market as such is giving you 12% return, then considering the risk that I have in my security, how much return should I get? That is what we are computing here. Yes, Tambeshwari.
सर हमने 10% को रिस्क था इसलिए लिया, लेकिन सर ये 12% मतलब हम 2% क्यों नहीं ले सकते? क्योंकि 10% हमारा रिस्क है, तो रिस्क को हटा
10%
देंगे।
risk नहीं है. नहीं. 10% is the risk premium, Baba. If you invest in market, you get 12% instead of 7% in the risk-free security.
तो सर हम 7% प्लस 2% क्यों नहीं कर सकते? क्योंकि
2%
ये
कैसे?
तो
अरे 2% कैसे? From where you are getting
रिस्क है
2%?
सर, 10% का तो रिस्क है। तो जो
कौन बोला?
ये
कौन बोला 10% का रिस्क है? किधर लिखा है?
मतलब प्रीमियम पर रिस्क है।
वो रिस्क, अरे प्रीमियम का रिस्क नहीं होता, रिस्क का प्रीमियम होता है.
हाँ सॉरी सर, रिस्क पर
तो
प्रीमियम।
5% is the risk premium of the market. If I am having risk of double that of market, how much risk premium will you need? double of that. So that will be 10%, right?
Okay, sir.
So risk premium from the share is 10%.
Yes, sir. Thank you, sir.
Okay. Omkar,
सर आईआरआर में हम जब रेट कंसिडर करते हैं तो
हाँ,
उसे कब कम करना है और कब डिक्रीज करना है सर, उसके बारे में
जब भी
थोड़ा
वैल्यू को
बताइए।
डिक्रीज करना है आईआरआर के रेट को बढ़ाएगा। जब भी
ओके सर।
वैल्यू को डिक्रीज करना है आईआरआर के रेट को बढ़ाएगा, और जब इंक्रीज करना है तो आईआरआर के रेट को गिराएगा। ऑपोजिट डायरेक्शन में जाएगा दोनों।
इंक्रीज, ठीक ठीक है सर, थैंक
ठीक है। ओके, सो let's take a break now. After the break, we will take up the last concept here, which is the cost of reserves and the weighted average cost of capital, and then do few questions based on that. Okay. we were in the cost of capital. We have like covered the cost of debt, cost of preference share, cost of equity. Now let's look at another cost concept, which is the cost of reserves. Okay. Now, cost of reserves. How do we really go about calculating the cost of reserves? The amount of reserves that we have in our books. Can you tell me to whom does it belong to? Cost of reserves. To whom does it belong to, guys? I mean, the reserves belong to whom? Yeah. Who are the real, persons who are actually owning the reserves? The equity shareholders, the owners, right? So if I'm giving money to the equity shareholders by way of equity share capital. I mean, being an equity shareholder, if I'm giving money to the company in the form of equity share capital, and company is earning profits on that, and company is not paying out that earnings to me. Company is not paying out that earnings to me, but rather it is retaining the money. So what return am I going to expect from the equity shareholders? What return am I going to expect from the company as an equity shareholder? Yeah. Can I say I'm going to definitely expect the same return as KE. If whatever is the KE, the rate at which I would have given the money to the company, being an equity shareholder in the form of share capital, that same return is what I would be expecting. That same return is what I would be expecting from the reserves. Am I right? The money that I'm giving to the equity shareholders, money that is being given to the company as an equity shareholder, let's say I expect 18% on the equity share capital. How much would I expect on the retained earnings? Can I say same 18%? Because it is it's my money itself which is lying with the company. You call it equity share capital, or you call it as retained earnings, or you call it as reserves. But ultimately, what is the conclusion? The money belongs to whom? The equity shareholder. So cost of retained earnings is simply going to be equal to cost of equity. Okay, so just take a note of it. Cost of retained earnings, or KR. KR is simply going to be same as KE, which can be dividend model, which is dividend per share upon market price per share, or it can be even the earnings model, which is earnings per share upon market price per share, or it can be even growth model, which is D1 upon P0 plus G, or we can also say it is maybe the same as CAPM, which is RF plus beta multiplied by RM minus RF. So it's just going to be the same. So there's nothing different in the retained earnings cost as such, because it's ultimately the money of the equity shareholders. So since it's the money of equity shareholders, the expected return is also going to be the same as the cost of equity. Okay, guys, clear? Now, the last concept is weighted average cost of capital. Weighted average cost of capital. Now, one thing to note is whenever the question gives you any information regarding flotation cost, whenever the question gives you any information regarding the flotation cost, that flotation cost is always going to be subtracted from the market price. Okay, because whatever is the market price, from that you're going to subtract the flotation cost. Because if you're issuing, let's say, shares for a price of 100, and then you have a flotation cost of 5%. So market price of the share is 100. But what is the amount that you will receive? What is the amount that you're going to receive, guys? If 100 rupees the market price, you're issuing the shares, and 5% is the flotation cost, what is the amount that you will receive as a company? Yeah, what is the amount that you will receive as a company? Can I say you're going to receive 95? Correct? So that 95 is going to be considered as a denominator. So whenever the question gives you something like there is a flotation cost, you need to subtract it from the current market price, because you're not going to receive the full value, but you're going to get a reduced value. Okay, so weighted average cost of capital. Now, in this concept of weighted average cost of capital, what are we really going to do? We are going to calculate the cost of capital not for one typical source of fund, but we are going to calculate the cost of capital for multiple funds together. So for example, we have capital as equity shares. Okay, we have capital in the form of reserves or retained earnings. Okay, then suppose we have equity shares, reserves, then suppose we have debentures also issued, and we have preference share capital. Okay, preference share capital. Book values of them. Book values. So what are the book values that we have for equity shares? What is the book value that we have for the equity share? Let's say share capital is nothing but the face value that we have. So let's say equity shares are having a face value of 10 lakh. Reserves are having a value. We have got, let's say, 3 lakh of reserves in our books. We have got 5 lakh debentures in our books. And we have got, let's say, 2 lakh worth of 2 lakh face value of the preferentials. So when we take a summation, we say that total capital that is invested in the company is, total capital that is invested in the company is, let's say, 20 lakh. Now I'm looking for cost. Cost of capital. Cost of equity is suppose 20%. Cost of equity is, let's say, 20% because equity shareholders require a return of 20%. What about cost of reserves? Let's take it as same 20%. What about cost of debentures? Cost of debentures. Cost of debentures. Tell me, is it going to be more than 20, less than 20? Cost of debentures, is it going to be less than 20 or more than 20? Of course, less than 20. Let's say debentures are costing us 12%. What will be the cost of preference share? Let's say preference shares are costing us 15%. So now my question, listen carefully, guys. Listen carefully. On equity shares worth 10 lakh, the investors expect 20%, or I can say company needs to earn 20% of that. On reserves of 3 lakh, or reserves of 3 lakh, cost of capital is again 20%. So we require a return of 20% on the reserves. We require a return of 12% on the debentures, and we require a return of 15% on the preference share capital. Okay. So equity share capital is 10 lakh, on which we require 20%. On 3 lakh, we require 20%. On 5 lakh, we require 12%. On 2 lakh, we require 15%. Now my question is, what is the rate of return that I require on 20 lakhs? What is the rate of return that we require on 20 lakhs? Can I say we'll take a weighted average? As the name says, weighted average cost of capital, we need to first calculate the weights. So weights will be like 10 lakh divided by 20 lakhs. What will be the weightage for reserves? What will be the weightage for reserves? Can it will be 3 lakh divided by 20 lakhs? Weightage for debentures, it will be 5 lakh divided by 20 lakhs. And weightage for preference share, it will be 2 lakh divided by 20 lakhs. Can I say these are the weightages? Correct? These are the weightages that we have. Correct, guys? We have these weightages. Now, how to get the weighted average? Obviously, weights into cost. So, cost of capital into weights. Simply take the multiplication, right? So, we just multiplied the cost with the weightage, right? And then we take a summation of this entire. That is 17.5%. So, it means you have to earn 20% on 10 lakh, 20% of another 3 lakh, 12% on 5 lakh, preference share capital, you need to earn 15%. So on an average, overall on 20 lakh, you require a return of 17.5%. Correct, guys? On an average, a total return that we need is, overall return that we need is 17.5%. And this 17.5% is nothing but weighted average cost of capital, which is also denoted as KO. Weighted average cost of capital, which is also denoted as KO. Got it, guys? How to compute the weighted average cost of capital? Did we get it? How to compute the weighted average cost of capital? O means overall, yes. Can we merge equity and reserves? I would not recommend. Keep them separate because they are two separate sources of funds. Okay. What is the difference in weights and WC? This is weights into cost. Weights multiplied by cost of capital. Okay. Now, this is what we have done by book value basis. Now, if I give you some more information regarding this, let's say these are book values, but I tell you that each of the equity shares are having a face value of 10 rupees. Debentures are having a face value of, let's say, 100. Preference shares are having a face value of, let's say, 100. Right? In that case, these are the book values. Right? These are the book values. Now, after the book values, if I ask you, what is the number of securities? Number of securities is basically number of debentures or shares that we have. How many number of shares are there with the company? Can I say 10 lakh divided by 10 rupees? Reserves, of course, we cannot say the number of shares, right? Reserves are not something which is distributable one by one. So debentures is going to be 5 lakh divided by 100. What about the number of preference shares? What about the number of preference shares? Can I say 2 lakh divided by 100? That's the number of securities that we have. Now, if I give you information, market price of security. Let's say each of the shares are being traded in the market at a price of 25 per share. Debentures are trading at a price of 102. Preference shares are trading at a price of 99. Okay. Can you tell me what is the market value of securities? What is the market value of securities? Tell me, what's the market value of the equity shares of the company? overall market value, all shares together, what will be the market value of equity shares? Market value of all equity shares. 25 lakhs. Can I say it will be 25 into 1 lakh? Okay. Tell me, what is the market value of reserves here? What is the market value of reserves? There is no market value for reserves. Have you ever heard that reserves of a company are being sold in the market? Have you ever heard that reserves of Infosys is being sold at a price of so and so? Reserves are not sold at all. In fact, you know what? Whatever is the market value of the shares, market value of shares include the market value of reserves. Market value of shares includes the market value of the reserves. Or I can say, so this 25 lakh is actually the market value of both equity shares and the reserves. Because whoever is having the equity shares, he or she is definitely entitled to the reserves of the company. Am I right, guys? If I'm holding one share, I will be entitled to a proportionate share in the reserves. So I have to pay how much price? I have to pay definitely the price which I need to pay for both equity shares as well as reserves. Then, what will be the market value of debentures? Market value of debentures. Can I say 102 into 5,000? Market value of preference shares will be 99 into 2,000. So what's the market value of all the funds that are invested? Market value of all the funds that we have is 32 lakh 8,000. Correct? 32 lakh 8,000, right, guys? Yeah. Okay. Just as we took, cost wise, this was 20%. The debentures were asking for 12% and preference shares were asking for 15%. So from a market perspective, overall market perspective, equity shareholders with their 25 lakh investment are expecting a return of 20%. Then debenture holders with their 5 lakh 10,000 investment are expecting a return of 12%. The preference shareholders with their investment of 1,98,000 are expecting a return of 15%. So if I ask you, what is the overall return that is expected on the total capital, which is 32 lakh 8,000? How do I get that? How do I calculate that? Can I say again weighted average? Sir, what's the difference between this weights and the weights that we are going to calculate? These weights are book value based weights. These weights are basically book value based weights, right? Now, here that we are going to calculate weights are based on, can I say, market value based. We can get weighted average cost of capital using how many methods? We can get weighted average cost of capital using how many methods? 2 methods. Either you can take book value and calculate the weights, or you can calculate first the market value and then calculate the weights. Sir, are we going to get the weighted average cost of capital number same in both cases? Of course not. It's not going to be same. It's going to be different. So market value based weights, when we are calculating, this is going to be market value of securities divided by total 32 lakh 8,000. Then weights of debentures will be market value of debentures divided by the weights. And then market value of securities divided by this weights. So if you obviously take a total of it, this will definitely come out to be 1. So market value based weights are calculated in this manner. Now, since we have got the weights, we can get weight into cost, right? So that is cost multiplied by the weights, right? Simply convert this in percentage form. Yeah. And then when I take a summation of this entire, this comes out to be 18.42. So you can see there is definitely a difference. This 17.50 that we got, weighted average cost of capital KO of 17.5%, This is book value based weighted average. Whereas this 18.42 is market value based weighted average. Okay. There is book value based weighted average and the other is the market value based weighted average. Yes. Can I give you a problem to solve and give me the book value based weighted average and market value based weighted average? Yes. Can you solve it? Yes. Okay. Let me just give you the details then. Let's say we have got capital, equity share capital, reserves, debentures. You have to chat with CA Jagbandhu, not JB. JB was just for that's just for sharing the screen. Okay, Vibhor, I think you were not there yesterday. Bank loan, preference share capital. We have the capital, then the amount. So let's say the amount is 3 lakh. Reserves are 23 lakh. Debentures are 24 lakh. Bank loan is for 13 lakh. And preference shares are issued for, let's say, 20 lakh. Equity share capital is having a face value of 10. Debentures are having a face value of 1000. Preference share capital is having a face value of, let's say, 100 rupees. The cost for them is, let's say, 18%. Of course, cost for reserves is also 18%. Debentures are having a cost of, suppose, 11%. Bank loan, there is a cost of 10%, and preference shares are having a cost of 14%. Market price of security, market price of equity shares and reserves. So equity share capital is having a market price of, suppose, 45 per share. Debentures are having a market price of 1025. Bank loan, of course, there won't be any market price for bank loan. So bank loan, you have to take it at book value itself. Preference share capital are having a market price of 103. Give me the weighted average cost of capital based on book value and also weighted average cost of capital on market value. Yeah. So try to solve this, guys, quickly. Yes, Sai Kiran.
Sir, previous after market value based weights, you have given a WC and you have calculated rate of interest. How that work came? Can you please explain, sir? 15.59, 1.91, 0.93. How that work came?
It's simply cost multiplied by weights, 20 into 0.7793.
This 0.7793 is out of total 32.8 lakhs, 25 lakhs value.
Yes. 25 lakh out of 32 lakh 8,000.
Okay. Okay.
Try to get the WACC, weighted average cost of capital, using book value and market value, guys. Bank, of course, bank loan has to be taken. Bank loan is not traded in the market, but that is your liability. So, of course, bank loan, whatever is the book value, that itself will be its market value. I hope you would have got the weights already. Weights based on book value. Did we get the weights based on book value? Reserve calculate. Reserve is not considered when market value is considered. Because in market value, you don't get the value of reserves. Whatever is the value of equity shares, that is including model. Model is same as, but whatever is the cost of equity, that itself will apply to cost of reserves, because reserves are ultimately the money of equity shareholders. So whatever return equity shareholders are expecting on their capital, they will expect the same on the reserves also. Correct? Okay, so weights are check if you are getting these weights. Then what we need to do is weights multiplied by cost. This is weights multiplied by cost. Totaling to 15.29%. Book value 15.29%. $50.2728. That's okay. Some here and there, something it may be there. Some rounding of effect will be there. That is okay. Approx to 15.2 is what we are expecting. Took two decimals, that became 14.98. Yes, if you take two decimals, the numbers will be different. But I would recommend you to go for 4 decimal, because that gives more or less an appropriate answer. We need to compute the market values, market value weights. For that, we need to compute the market values. Market value of equity share, guys. What's the market value of equity share? Of course, it's 50 lakh, but that needs to be divided by 10 to get the number of shares, and then you multiply it with the market price. So just check, is the market value of the shares 2 crore 25 lakh? Market value of the shares, is it 2 crore 25 lakhs? Yes, guys, correct. Market value of shares 2 crore 25 lakhs. Okay. What about the market value of reserves? What about the market value of reserves, guys? Market value of reserves will not be considered, it's 0, because that reserve is already clubbed with the market value of equity shares. Then, regards to debenture, it's going to be 24 lakh divided by 1000 multiplied by 1025. Then bank loan market value will remain 13 lakhs. preference share capital market value will be 20 lakh divided by 100 multiplied by current price, which is 103. Market values are 20 lakh 60,000. Okay. So total market value of all the funds is 2 crore 83 lakh 20,000. Now, based on this, we can get the weights, right? So weights will be simply market value divided by the market value of individual security divided by the total market value. Okay. Then we can simply drag it down. Of course, the summation of all weights is going to be 1. Is the weightage correct? Yeah. Then weights into cost. Weights into cost. So weights multiplied by the cost, which is 18%. We take a summation that comes out to 16.73%. Is it right? 16.73%, approximately 16.73%. Got it, guys? Approximately 16.83%. Yes. 17.04. Okay. If you would have taken like 2 decimals, then possibly you will get this as 17.04%. MG calculation. What is MG calculation? What is MG? MG is the name of an automobile company. Market value. Okay. Market value will be amount divided by the face value, right? And then you multiply it with the market price of the share. So face value of equity shares is total 50 lakh. You divide it by 10 to get the number of securities like we over here, like we did over here. And then you multiply it with the current market price of one security. Got it? Well, getting this 16.73 number. Yes, guys, are we getting the 16.73 number? Mine is 16.48. Is it okay? Yes, it's okay. Sixteen point 16.72. Okay. Approx 16% around you may get. Some difference may be there here or there. That's okay. Okay, let me just do one last question, guys. One last question, which is again based on the realized yield, but it's a bit different thing. Realized yield approach, a different approach or a geometric mean method to calculate the realized yield approach. So this is geometric mean method to calculate realized yield. We are looking at geometric mean approach to calculate the realized yield. Let's try to understand this. So here when we consider the price and then we consider the dividend per share. So year 0, 1, 2, 3, 4. So let's say current in year 0, let us say price that we had was 9 rupees. First year, the share price became, let's say, 9.75. Second year, the share price became 11.50. Third year, the share price became 11. And in the last year, the share price is 10.60. Okay. The dividend that an investor is receiving on this is, let's say, 1 rupee in first year, 1 rupee in second year, then 1.20 in third year, and 1.25 in the fourth year. So these are the dividends that an investor is getting from the security. Now, if I ask you, what is the rate of return earned by the investor? Can you tell me what's the rate of return earned by the investor in year 1? So suppose you bought a share for 9 rupees, okay? And the share price is right now 9.75. And you have also got 1 rupee dividend. So what is the total return that you have got from the share in rupee terms? In rupee terms, what is the return that you have got? First, can I say 0.75? There is a rise in the price. That is an income for me. 0.75 is the rise in price, right? So that's the income for me. Plus, also I received 1 rupee. Correct? So rate of return, can I say it is 1.75 is what we are earning on an investment of, in the 0th year, what was the price? 9 rupee, right? So suppose I purchased the share in 9 rupee and now the share price is 9.75. So obviously 0.75 is the rise in the price, plus also I received 1 rupee. So this is the income that I have. 1.75 is the income that I have. Right, guys? 1.75 is the income that I have. This is the income which I have earned on an investment of how much, guys? This is the income that I have earned on an investment of 9 rupees, correct? So this is 1.75 divided by 9. So that translates to 19.44%. 19.44%. What is the rate of return that investor has earned in the second year? What is the rise in price in the second year? By what amount has the price increased? From 9.75 to 11.5. It has increased from 9.75 to 11.5. Can I say there is again an increase of 1.75? Plus, you also receiving a dividend of 1 rupee, right? What's the total income that you're receiving? 2.75? Achha, this is a 2.75 return that you are getting on an investment of how much? On an investment of how much? Can I say on an investment of 9.75? I am getting this 2.75 in the second year on the first year price of 9.75. So how much is the rate of return? 2.75 divided by 9.75, which is 28.21. 28.21%. Okay. What about the third year? Third year, what is the return that we are getting? The price has actually reduced from 11.5 to 11. The price has reduced, right? From 11.5 to 11. So can I say there is a loss of 0.5? But you are getting a dividend of 1.2. So what is the net thing? What is the net thing that we are having? 1.2 dividend minus 0.5 loss. So can I say 0.7 is the gain? 0.7 is the gain that you're getting on what base value? Can I say 11.5 on an investment of 11.5? So this is 0.7 divided by 11.5. This is 6.09%. In the fourth year, the price has further reduced to 10.6. So price has been reduced by 0.4 minus 0.4, and you have a dividend of 1.25. What is the amount wise return? Can I say 1.25 minus 0.4? So 1.25 minus 0.4 is going to be how much? 0.85 on an investment of how much? What is the investment in year 3? 11, right? So this is 0.85 divided by 11. That is 7.72% or 7.73%. So these are the returns that we have earned in first year, in second year, in third year, and in fourth year. Right? Okay. Do you know how to calculate the geometric mean? Geometric mean? Reduce point explain. The share price has reduced from 11.5 to 11. Share price has reduced from 11.5 to 11. So there has been a reduction of 0.5 rupees. Now that 0.5 rupees is a loss for you, but you are receiving a dividend of 1.2. So you received 1.2, you received 1.2, and you're losing 0.5. So what is the net gain for you? 0.7, right? Got it? Ambeshwari. Yeah? Okay. So what's the formula for geometric mean? Geometric mean, if it is two values, we say it is, square root of A into B. If it is three values, let's say A, B, C, how do we take the geometric mean? Geometric mean is basically taking an average. Can I say it to the power of 1 by 3? If it is four values, can I say A, B, C, D to the power of 1 by 4? Correct, guys? Yeah. Now, something of this sort we are going to do over here also. Geometric mean return. Right? The geometric mean return is going to be computed over here in the similar lines. What we do is value of rupee 1 invested in year, value of rupee 1 in year 1, which was invested, let's say in year 0. How much is that value going to be? What will be the value of 1 rupee? If you have invested in year 0, how much would have that become? Because your return is 19.44. If your return is 19.44, what would be the value of 1 rupee after a year? Can I say it will be 1 plus 19.44%, or I can simply say that this is 1 plus 19.44, or we call it as 1.1944. Same way, tell me what will be value of rupee 1 in year 2, which was invested in year 1. Yeah, tell me, what will be this number? Can I say 1 plus 28.21? $1.2821. What will be value of rupee 1 in year 3, which was invested, let's say, in year 2? What will be the value of 1 rupee which was invested in second year? Can it will be 1 plus this 6.09%, 1.0609. And same way, what will be value of rupee 1 invested in year, or value in year 4 when you are invested in year 3? What is it going to be? 1 plus 7.1.0773. Correct? Now, please observe this chart properly. ₹1 will become 1.1944 by year 1. tell me by year 2, can I say this 1.1944 will further get increased? I mean, 1.1944 will further get increased by 1.2821, because second year you are earning a return of 28.21%. So the value of one which has become 1.1944, that will further get multiplied by 1.2821. Then can you tell me what will happen by year 3 from year 2? 1.1944 multiplied by 1.2821 multiplied by 1.0609. Can I say the value of 1 rupee in year 0, that becomes 1.1944 in year 1, further gets multiplied by 1.2821 in year 2, further gets increased by 6.09% or multiplied by 1.0609 in year 3, and then in year 4 this will be how much less? 1 point I don't know, where has it gone? Last year, what will be the value? Last year, what will be the value? It will be 1.1944 multiplied by 1.2821 into 1.0609 into 1.0773. So what's the cumulative value of 1 rupee? 1.7501, right? So can I say, sir, rupee 1 of year 0 becomes 1.7501 in year 4? Can I say this? 1 rupee invested today becomes 1.7501 in year 4. Okay. So now, what is the rate of return per annum that you would have earned? Can I say amount? We know it is principal into 1 plus I raised to n. So amount is 1.7501, which is principal is 1. So 1 plus I raised to 4. So it will be 1.7501 to the power of 1 by 4. That 4 comes to the other side to the power of 1 by 4 equal to 1 plus I. Now give me the fourth root in the calculator. What you do is 1.7501. Just take a square root of it. Press 2 times square root. This is there. 1.7501. I'll just take the square root twice. So is it 1.15? 1.1502, which is 1 plus I. So I is nothing but 15.02%. This is simply your geometric mean. Now, if you observe, what we did is we simply multiplied. We simply multiplied the returns. We simply multiplied the individual factors, and then we took a fourth root of that, just like geometric mean. Had it been 4 numbers, we would have taken the fourth root. So even in this case also, we have taken the fourth root. You can see this is the fourth root that we have taken, 1.7501 raised to 1 by 4. So every year, the factor that is getting multiplied is close together, and then we are taking the fourth root, and this is what we call it as a geometric mean return. Okay. Yeah, Hardik?
सर अगर बाय चांस सर जैसे इक्विटी के लिए यूज होता सकता है तो सर यही सेम चीज डिबेंचर्स के लिए भी हो सकती है ना, अगर फ्लोटिंग रेट डिबेंचर हो.
हाँ, yes, correct, perfect. अगर if every year there is a different rate of interest, then you need to get these factors multiplied and then take a geometric.
और सर अगर वो एक और चीज बता दो सर, वो क्यूब रूट 3 होगा तो कैसे करेंगे कैलकुलेटर में?
क्यूब रूट के लिए I don't know whether this is going to work. यहाँ पे मैं कैसे दिखाऊं तुम्हें? क्यूब रूट वैसे फिलहाल तो वैसे क्वेश्चंस होगा नहीं, बट स्टिल यू कैन गेट इट, लाइक फॉर एग्जांपल इफ यू वांट 27 का क्यूब रूट, वी नो व्हाट इज 27 का क्यूब रूट?
3
3। तो कैलकुलेटर है तेरे पास?
है सर।
है तो चल, जैसे जैसे बोलते जाओ वैसे वैसे स्टेप्स करते जा।
ठीक है सर।
ठीक है, रूट का बटन दिख रहा है, स्क्वायर रूट का?
हाँ जी सर, दिख रहा है।
उस रूट के बटन को बेटा 12 बार प्रेस कर।
1 2 3 4 5 6 7 8 9 10 11 12 कर दिया सर।
1 पॉइंट समथिंग किया, 1 पॉइंट समथिंग आया रहेगा।
1.008049।
ठीक है, तो रूट को मैं भी चल करता हूँ, एक सेकेंड ना, 7
सर
को।
आप वो एंटी लॉग वाला सिखा रहे हो क्या, जो एंटी लॉग करते हो कैलसी पे?
ना ना ना, यही कुछ आया तेरा 12 टाइम्स रूट के बाद,
यही
देख।
सेम आ रहा है, यही सेम आ रहा है।
सेम आ रहा है। अब एक काम कर, बिना इक्वल टू दबाए
हाँ जी सर।
प्रेस -1।
-1। ठीक है सर।
-1 किया।
हाँ जी सर।
ठीक है, -1 करने के बाद फिर करना डिवाइड बाय।
डिवाइड बाय।
तेरे को कौन सा चाहिए? क्यूब रूट चाहिए, राइट? यू नीड द क्यूब
हाँ जी
रूट।
सर।
डिवाइड बाय 3 करेगा।
3 करा।
ठीक है, इक्वल टू नहीं दबाया ना अब तक?
नहीं दबाया सर।
डिवाइड बाय 3 किया, फिर उसके बाद करेगा +1।
+1।
हाँ, ये कर लिया +1।
हाँ जी सर।
+1 करने के बाद अब क्या करना है? इनटू और इक्वल टू, मतलब मल्टीप्लीकेशन और इक्वल टू के बटन
12 बार
12
प्रेस।
टाइम्स प्रेस करने हैं, लाइक इनटू इक्वल टू इंटू इक्वल टू इंटू इक्वल टू, ऐसे 12 टाइम्स।
1 2 1 2 3 4 5 6 7 8 9 10 11। आ गया सर।
आ गया? 3 आ गया।
थ्री
थोड़ा
पॉइंट
डेसिमल होगा, बट दैट इज
हाँ
ओके।
सर, वो तो समझ में आ रहा है। ठीक है, थैंक यू सर।
ओके।
ठीक है सर, थैंक यू सर। और
ओके।
सर एक और चीज़ पूछनी थी। सर अगर बाय चांस रेशियोज में ऑपरेटिंग प्रॉफिट मार्जिन दिया हुआ है तो ईबीआईटी अपॉन नेट सेल्स इनटू 100 है ना?
जी बराबर।
और सर अगर ऑपरेटिंग इनकम ऑन रेट ऑफ इन्वेस्टमेंट है, रिटर्न ऑन इन्वेस्टमेंट है, तो सर वो ईबीआईटी अपॉन में कैपिटल एम्प्लॉयड इनटू 100 है ना?
हाँ।
ठीक है, बस यही पूछना था। थैंक यू सर।
ओके, so next session onward, if I ask question or someone asks question, do not allow more than one student to unmute the mic. Yes.
So A is equal to maturity value, P is equal to principal. Is it correct, sir?
Yeah.
Okay, okay, sir.
A is the amount. P is the principal.
A is maturity, na?
Maturity or the amount.
Okay.
Okay. So with that, let's just stop here. Okay. So Dupont model and all, we have revisionary classes. So in that, we'll do more questions on this cost of capital and also on the ratio. Okay. So let's just stop here, guys. See you in the next class, guys. Bye bye. Take care, guys. Yes. Good night. Good night.